pleasure for welcoming you all for Unit 2 presentation of Business Finance. I am Dr. T. Usharani, Assistant Professor from Department of Commerce, Kumaraguru College of Liberal Arts and Science. In Unit 2, it covers the essential components of financial plan from its meaning and concept to objectives, types, steps, significance and fundamentals. The focus is on understanding how financial planning helps businesses manage their finance, achieve growth and prepare for potential risk. Financial planning is not merely about budgeting, it encompasses a holistic approach to managing finances, ensuring that we allocate resources effectively to secure a prosperous future. Whether you are a budding entrepreneur, a finance professional or someone keen on managing personal finance, understanding these principles will serve you well. Let's get started on this enlightening exploration of financial planning where knowledge becomes the foundation for sound financial decisions and lasting success. By the end, you will gain insights into why every business from startups to large corporation need a well-structured financial plan to ensure long-term sustainability. Let us discuss the introduction of the financial planning. A financial plan is a strategic roadmap that outlines an organization's financial goals and provides detailed steps to achieve them. It covers every aspect of company's finance including income, expenses, investments and debt management. A strong financial plan helps business make informed decisions, manage resources efficiently and stay financially stable in both short and long term. It involves creating budgets, forecasting revenues, controlling costs and planning for risk. For example, a company might use a financial plan to decide how much to spend on marketing, how much profit to expect from sales and how much to save for unexpected expenses. Overall, it's like a blueprint for the business financial health. Concept of business financial plan. It revolves around organizing and optimizing a company's financial resources to meet its objectives. The plan serves as a guide for making decisions related to investments, cost management and profitability. By having a clear picture of its finance, a business can plan its growth strategy, ensure smooth day-to-day operations and handle risk more effectively. Key element of this concept include revenue generations, how much money the business expects to make and cost management, how the business plans to control its expenses and risk management, how to deal with financial challenges. Together, these elements form the foundation of a sound financial plan. Let us now move on to objectives of a business financial plan. The objective of business financial plan or what the business wants to achieve with its finances. One of the primary goal is financial stability, ensuring that the business has enough cash to meet its need and survive in the face of challenges. Another key objective is profit maximization, helping the business generate as much profit as possible by carefully managing its revenues and expenses. Business also use financial plans to guide business growth. Whether it's expanding into new markets, launching a new product or increasing production, a financial plan ensures that the necessary resources are in place to support these initiatives. Risk management is another objective as businesses need to prepare for uncertainties like market fluctuations or changes in consumer behavior. Lastly, investor confidence is very critical. A solid financial plan attracts investors by showing them that the business has a clear and achievable financial strategy. Now, let us see what are all the types of business financial plans. Businesses can have different types of financial plans depending on their needs. The first type is short-term financial plan which focuses on immediate needs like managing day-to-day operations and the cash flow. This plan typically covers 1 to 3 years and ensures that the business can meet its short-term obligations like paying employees and suppliers. The long-term financial plan looks further ahead, usually covering 5 to 10 years. This plan might focus on major projects like expanding into new markets or building new facilities. The third type is the corporate capital structure plan, which deals with how the business raises money. Its importance for businesses to find the right mix of debt and equity, that is buying money and selling shares, to finance their operations while minimizing the cost. A contingency financial plan prepares the business for unexpected events such as an economic downturn or a sudden loss of revenue. By having alternative strategies in place, businesses can quickly respond to crises and minimize the impact on their operations. Moving on to the steps in developing a business financial plan. Creating a business financial plan involves several steps. The first step is to assess business environment by analyzing the market, competitors and business current financial performance. This gives the business a clear picture of where it stands and what challenges or opportunities lie ahead. Next, the business should set financial goals. These goals should be specific and measurable while increasing revenue by 10% or reducing cost by 5%. After setting goals, the business needs to create a budget that outlines how much money will be spent on various areas like marketing, salaries and operations. Once the budget is in place, the business should forecast future financial performance by predicting how much money will be coming in and going out. This helps ensure that the business has enough cash and for covering its expenses. Resource allocation is the next step where the business decides how to use its financial resources to meet the goal. Finally, the business should monitor and adjust its financial plan regularly to keep up changes in the market or its financial situations. Shall we now move on to the significance of financial plan? Financial plan is crucial for ensuring the financial health and success of a business. One major benefit is that it helps a business stay financially stable by providing a clear roadmap for managing its resources. This ensures that the business has enough cash to cover its expenses and can continue operating even in tough economic conditions. Another important aspect of financial planning is that it supports decision making. A well-structured plan provides valuable data that can guide important decisions such as whether to invest in new equipment, launch a new product or enter into a new market. A strong financial plan can also help attract investors and lenders by demonstrating that the business has a clear path to profitability and growth. In addition, financial planning plays a key role in risk management. By forecasting future performance and preparing for potential challenges, businesses can minimize the impact of unexpected events. Ultimately, a financial plan enables businesses to pursue growth opportunities with confidence, knowing that their financial resources are being used effectively. Let us now discuss about the fundamentals of financial planning. Cash flow management. For businesses, cash flow management is critical to ensure operational stability. It involves tracking cash inflows from sales and investments and outflows to expenses like payroll, inventory and rent. For example, retail chain in India like Big Bazaar might closely monitor its cash flow to meet daily operational costs and manage vendor payments, ensuring it has enough liquidity for peak sales period or unforeseen expenses. Effective cash flow management can help avoid reliance on short-term loans and maintain a positive cash cycle. Next is debt management. Businesses often use debt management strategies to optimize financing costs and avoid financial strain. Effective debt management might involve restructuring existing debt, refinancing at lower interest rate or repaying high cost loans early. For instance, Tata Motors has refinanced debt at favorable rate to manage its capital structure and reduce financing cost. This strategy frees up more capital for other business operations such as product development and market expansion. The next one is investment planning. Investment planning helps businesses allocate capital to projects with high returns supporting long-term growth. It involves decisions on whether to invest in new product line technology or market expansions. For example, Infosys invests significantly in R&D for technology innovations, enabling it to remain competitive in global market. By carefully selecting investments, businesses can ensure resources are directed to initiatives that align with strategic goals and yield the highest returns. Next one is risk management, which is essential for businesses to protect assets and ensure continuity. This includes identifying risks such as market volatility or supply chain disruptions and implementing mitigation strategies. An FMCG company like Hindustan Unilever in India might use risk management strategies such as diversified sourcing and hedging to stabilize cost. Additionally, contingency planning helps businesses adapt quickly to changes, ensuring resilience in uncertain markets. Now let us discuss about the budgeting and cash flow management. First one is income tracking, which is vital for understanding a business's revenue sources and seasonal trends. Companies like Flipkart, which have seasonal spikes during sales events, track income to optimize inventory and staffing levels. By knowing peak revenue periods, businesses can better allocate resources to maximize returns, ensuring they capture demand while avoiding overstocking during off-peak times. Moving on to the expense monitoring, it allows businesses to identify cost-saving opportunity and control overheads. For example, Maruti Suzuki might track production and administrative expenses, categorizing cost into fixed and variable. This helps them manage margins more effectively, especially in a competitive industry where cost efficiency can lead to significant competitive advantages. Detailed expense monitoring also enables better forecasting and financial planning. Let us now discuss about the budgeting. A budget serves as a financial guide for a business, setting spending limits for different departments while ensuring alignment with strategic goals. A company like Reliance might allocate specific budget for expansion, R&D and marketing based on the expected return. For instance, it may allocate higher budgets to its telecommunications arm, geo-focusing and customer acquisition while keeping operating costs within the set budget. Proper budgeting promotes efficient use of resources and avoids unnecessary spending. Let us move to investment and wealth creation. It consists of asset allocation, which helps businesses balance risk and return by diversifying investments. Large companies like Aditya Birla Group diversify assets across sectors such as finance, telecom and cement to reduce risk exposure and ensure a steady income stream. Asset allocation enables a business to leverage high growth areas while maintaining stability in core sectors, supporting long-term wealth creation. The next one is portfolio. Monitoring portfolio allows businesses to evaluate, adjust investments regularly. For example, HDFC Bank reviews its loan portfolio to manage risk and optimize returns, adjusting exposures based on market trends and risk profiles. By continuously monitoring investments, businesses ensure their portfolio aligns with financial objectives, responds to market changes and maximizes overall performance. Another strategy is tax efficiency, which helps businesses retain profits and reinvestment in growth. For example, Indian IT companies like TCS may leverage tax incentives for R&D and investment in special economic zones to reduce tax burdens. By using these strategies like depreciation on capital assets or investing in tax efficient financial instruments, businesses optimize tax liabilities, increasing retained earnings for reinvestment in the business. Shall we now discuss about the key takeaways of business finance? Strategic roadmap for financial success. Financial planning involves a structured roadmap that helps businesses align their financial resources with their goals. By setting clear financial objectives and strategies, organizations can make informed decisions that support growth and sustainability. Efficient resource allocation through financial planning, businesses can ensure that resources are allocated effectively. This involves budgeting for operations, investments and future growth, helping to optimize cash flow and minimize unnecessary expenses. Risk management and adaptability, that is, well-crafted financial plan enables businesses to anticipate potential risk and prepare accordingly. By regularly reviewing and adjusting the financial plan, companies can stay resilient in changing economic conditions, making it easier to adapt and maintain financial stability. In conclusion, a financial plan is an essential tool for managing a company's finances and ensuring its long-term success. By integrating elements like budgeting, forecasting and risk management, a financial plan helps businesses stay on track and achieve their financial goals. It ensures that the business using its resources effectively, preparing for risk and pursuing growth opportunities in a strategic way. For any business, large or small, having a solid financial plan in place is critical for building investor confidence, making informed decisions and securing the financial health of the organization. It is important to remember that a financial plan is not static. It should be reviewed and updated regularly to reflect changes in the business environment and the company's financial situation. Now it's time to take the assessment. This assessment includes 10 multiple choice questions designed to help reinforce the key concepts from Unit 2. Each question presents 4 options and you will have the chance to select the answer that best fits the question. As we conclude our exploration of financial planning, it's vital to emphasize that the process should be dynamic and adaptable. In today's fast-paced business environment, organizations must regularly revisit and revise their financial plan to respond to changes in marketing conditions, economic trends and regulatory frameworks. By prioritizing robust financial planning, businesses can foster resilience, enhance stakeholder confidence and ultimately drive success. Thank you for your engagement in this vital discussion on financial planning in the realm of business finance. I look forward to our continued exploration of this essential topic in our future sessions. Thank you.